we are going to do the final chapter. It's a CGT, capital gains tax. And then I've developed some independent questions that we did before. If you're done with the CGT, then we'll move on to those questions and then we continue our things. Okay. Right, that's Learning Unit 7, capital gains tax. It's introduced as follows. It's a tax which does not form part of the gross income, but are subjected to CGT, which is a capital gains tax. So you'd have to look at your framework for the taxable income on page 65 of the tutorial letter. That gives you an indication of where the CGT fit. And it is included before the retirement contributions and donation in accordance with the framework. So in order for you to actually complete your successful CGT, you need the following components: your assets, your disposals, and the proceeds, along with your based costs. All right, the assets, disposal, and calculations of the capital gains and losses of an asset before the capital gains tax can be applied. An asset must be disposed of. The asset of the income tax defined an asset as including the property of whatsoever nature, whether movable or immovable, corporeal or incorporeal, excluding any currency but including any coins made mainly from gold or platinum. And the right or the interest of whatever the nature to or in such property. The definition of an asset, it is important as the CGT with few exceptions. It's not triggered until the asset it is disposed of. And a wide definition has been ascribed or described to the term, which includes all forms of the property and all rights or interest in such property. Looking at a few examples of the asset are listed below. We've got the land and building if they are disposed, factory, building, or a person's home or a holiday home. We're looking at the shares, we're looking at the collectibles, for example, jewelries or an artwork. Personal use assets, for example, we've got a boat. Disposable of a CGT will be triggered when a disposal or deemed disposal as ascribed law takes place. And as a rule, an asset is acquired or disposed of whether there is a change in the ownership of an asset. So basically, when you are dealing with the capital gains tax, there must be an asset that has been disposed or sold, and then we're going to look at how much did that asset, how much was it acquired for, which is actually called the base cost. All right, so disposal can occur when an asset is sold, donated, scrapped, exchanged, for example, with a share swap, lost, for example, due to theft, or destroyed due to fire, or when it is redeemable or cancelled. So that's with regards to the examples in regards to the disposal of an asset. So the deemed disposal will occur in the following situation: where the natural person or individual or a legal entity ceases to be a resident in the Republic, according to the Immigration 67 in terms of the TAX1501 under the tutorial letter 103. Right, so bear in mind that we also previously we've dealt with a resident person and an unresident person. I think it was on Learning Unit 4, if I'm not mistaken, or 3. So that definition would still continue when we do a deemed disposal under the CGT. Again, in accordance with the death of an individual or the reduction of a debt, or where the ownership of an asset does not change, but for all intents and purposes, disposals does not occur. For example, certain derivative and value shifting transactions. The following are not deemed to be disposals. You can see I've highlighted that in red. Where a person transfers the asset as a security for the debt, that's actually not deemed as a disposal. Or where a person or an institution return the asset to the owner after settling the debt. The calculations of the capital gain on an asset. In order to calculate the capital gain or the loss for asset, very specific rules need to be applied. Whenever a taxpayer disposes an asset, as discussed above, a capital gain or a loss needs to be calculated. For each disposal of an asset, a separate capital gain or a capital loss need to be calculated. So this is explained in this way. Let's say you've got multiple assets that you are disposing. All you do is you calculate the gain or the loss on the disposal of each and every individual asset. And then as soon as you are done with that, you're going to combine them together. We call them an aggregate capital gain or aggregate capital loss. All right. So you don't have to combine them when you do the calculations. You just have to separate them. And then after you separate each and every individual asset, and then you're going to combine them together and make it one. Right, here with a symbol in calculating the capital gain on the disposal of an asset or the capital loss. So you have the proceed, the X amount represent the figures, and then you're going to less the base cost, and then you're going to less any specific inclusions on the row with the amount as well. And then you are going to have what's called the capital gain or the capital loss of an asset. All right, so the framework would always be like that, but you just have to show it individually as per the asset items. Right, the capital gain will arise if the proceeds are more than the base cost, meaning that if your proceeds are greater than your base cost, you're going to have a capital gain, and the vice versa will be the capital loss. That is when the capital loss, it will arise when the proceeds are less than the base cost. Example, capital gain or loss. The capital gain or losses from individual asset, as I've explained, sold are added together to determine the aggregate capital gain or capital loss. The calculations of the aggregate capital gain or loss may be calculated as follows. Proceeds. The proceeds from the disposal of an asset by a person are equal to the amount received by or accrued to that person in respect of that disposal. It should be a disposal. There should be a scrapping of an asset or a sale of an asset. Right, meaning that the proceeds are the amounts received by or accrued to the seller who disposed an asset. So if you're selling, I'll just give you an example, a vehicle, for whatever the amount of money that you are receiving is called a disposal amount. No allowable adjustments to proceeds exist in terms of any cost, or only the following amounts can be used to reduce the proceeds for an individual taxpayer. Any amount that must be or has been included in the gross income, for example, the recoupment, or any amount is repayable to the person who purchased the asset. Right, second line item, base cost. Base cost of an asset in essence consists of three broader components, and namely the cost directly incurred in respect of the acquisition of an asset, how you acquired an asset or how you purchased your asset, the improvement that have been made on an asset, or the direct cost in respect of an acquisition and the disposal of an asset rather. The base cost of an asset depends on when the asset was purchased. That's a very important point that everybody else must just know. If the asset was purchased before the 1st of October 2001, the date at which the CGT was introduced for the first time, then we must calculate what's called the valuation date before we can calculate capital gain. All right, here's what happened. We used to have what's called the secondary tax on companies before, and it was replaced by the CGT on the 1st of October. So you need to be careful on the purchase date of an asset. Any asset that has been purchased prior to the 1st of October 2001, they're going to give you that intentionally just to test if you do understand the process on how you're going to get to your valuation date. So it means that there's a process that you have to follow. You just don't take it as it is, right? But any asset that has been purchased on the 1st of October onwards, that means that you're just going to take the cost of that asset as it is. Okay, going down further with the valuation date value, paragraph 22 of the 8th schedule provide the following list of the costs that may form part of the base cost. The purchase cost of an asset, the cost incurred in respect of the valuation of an asset, transfer cost, advertising cost to find a seller or a buyer, the moving cost of an asset, and the installation cost of an asset, the accounting and legal cost incurred in the sale of an asset. All right, so there are many factors that you are actually going to consider. Sometimes they just don't give you this is just the cost of an asset. You're going to look at other factors that might be in association with that specific cost of an asset. Like I gave an example, the cost incurred in respect of the valuation of an asset. That's an independent cost, but it is attached to the original cost of the asset. Transfer cost as well, including the advertising cost for the seller or the buyer. And then when you move an asset, it's going to be included as well. So some of the assets require a installation, and some they do require what's called the accounting and the legal cost in regards to the sale or the purchase of an asset. So the costs that are actually excluded from the base cost, sorry, borrowing cost, they're not included. That will include your interest to the bond registration cost to the bond cancellation cost, repairs and maintenance, protection and insurance cost, rates and taxes, any cost or the expenditure that have been deducted from the income for the income tax, even if they are listed above as being allowable. All right. So sometimes they're going to give you a bit of a scenario that has a base cost, and they're going to intentionally give you some costs that are supposed to be excluded from that. So you just need to be very careful when it comes to that. So what's going to happen is they'll give you how much the cost of an asset is, and probably they'll just say transfer cost is this, moving cost is this, and they're going to say protection and insurance cost or rates and taxes on that cost is this. So if you add them together, it's going to give you the final amount, which is incorrect because those are the excluded cost. But valuation date value is the value of an on the 1st of October or before, and this considered all the asset of an asset plus an increase in the value of an asset up to the 30th of September 2001. Any cost prior to the 1st of October, that would be regarded as the valuation date value. So that the question will tell you as to when was the asset purchased. If it was actually purchased before the 1st of October 2001, these are some of the considerations that you are going to look at. And the valuation date value is deemed to be the cost price of an asset as if you had acquired it on the 1st of October. So basically, you're going to do that valuation date value calculation as if it reflects the date of the 1st of October. And the valuation date value is determined by paragraph 26 or paragraph 27 of the 8th schedule of the Act. Right, let's get down to paragraph 26. Paragraph 26 is applicable when the adjusted proceeds are more than the adjusted cost of an asset, meaning that if there is a profit, my apologies, if there is a profit. And paragraph 27 is applicable when the adjusted proceeds are less than the adjusted cost of an asset. In other words, if there's a loss. So you just have to actually differentiate in between the two. Paragraph 27, proceeds are actually less than or equals the adjusted cost. This paragraph contains provision that serve as an anti-avoidance measure because a taxpayer can manipulate the market value of an asset to ensure that the capital loss is realized on the disposal of an asset. Right, so if you look at the equal sign or the greater, sorry, the less, so the intention there is just to avoid the taxpayer to manipulate figures in terms of the capital loss, because the reason why they would actually end up with the capital loss is because they just avoid to pay the 40% of the CGT. Okay, and the following steps are needed to calculate the valuation date value. Step 1, divide all the allowable costs between or pre the 1st of October 2001, post the 1st of October 2001. Step 2, identify the following three values. The market value, in order to make use of the market value of an asset, the owner had to have an asset valued by the valuator. So in accounting, we call it a sworn appraiser. So what they usually do is, if it's a house, they would just come and evaluate the house, and they're going to put them on how they do that. So, but it can be in any asset. It's just that it's used in accounting. We call them as sworn appraisals. So I think they are working for the bank in terms of the valuation. The general rule for determining the market value is that it should be calculated as the price that would have been agreed upon by the willing seller and the willing buyer on the 1st of October 2001. The market value will be provided to you in a question. So you don't have to worry about how are you going to calculate the market value, because it will be given in your question. So the second one, in terms of step 2, is 20% rule. You need to calculate this value as follows: 20% of the proceeds less the allowable cost incurred on or after the 1st of October 2001. This option will normally be used by a taxpayer who cannot prove the cost of an asset. Right, so that's one is quite easy. Just take 20% and then you multiply that by the proceeds. So you've got the TAP, which is time apportionment based cost. The time apportionment based cost spread, it spread the growth in the value of an asset over the origin asset or the owner owned an asset. And it further says that the TAP cost is the sum of the expenditure incurred before the 1st of October 2001 plus growth, which is the percentage profit of an asset before the 1st of October 2001. It's quite confusing. I don't think you will have to calculate that, or usually they would give you that in the example. But let's see what, in the question, let's see what the question further entails. It says that for the purpose of this modules, we will not expect you to be able to calculate the time apportionment based cost, meaning that you will be given that in a scenario or a question. The value will be supplied in a question, and you just need to know where it is used. Where the asset was actually purchased before the 1st of October, and you have to calculate the valuation date value. The greatest of the three options can be used. So meaning that you're going to look at the bigger value between your TAP, the market value, as well as your 20%. So the greatest of the three is the one that is going to be included when calculating the TDT process. Step 3, the final step in determining the valuation date is to apply the rules of paragraph 26 or 27 and select the valuation date to be used in the based cost calculation. So where the profits are greater than the expenditure, paragraph 26 of the 8th schedule, the valuation date value will be the greatest of the two. So the market value on the 1st of October will be given in the question, and the TAP will be given in the question, 20% of the proceeds. That's where you have to calculate. So there's no guessing when it comes to the CGT question. However, if the proceeds are actually less than or equals the market value, the taxpayer will not be allowed to use the market value as the greatest in the valuation date. The valuation date value will be the proceeds less the expenditure incurred on or after the 1st of October 2001. That's the anti-avoidance measure. Okay, let's look at the exclusions. The Act provides that certain capital gain or losses must be excluded before you calculate your capital gain or the losses for the year of assessments. Right, number one of that, it will be the primary residence exclusion. This is the most important provision for the individual because many people own a property in which they reside. If they sell the residence, the taxable capital gain can be reduced by applying this section. The residency must meet certain basic requirements before it qualifies as a primary residence. It must be a structure including a boat or a caravan or a mobile home. There are people who are actually living in a boat, caravan, or the mobile home, which is used as a place of residency by an individual. An individual or a special trust must own an interest in the residency, meaning that you must have a special interest in terms of ownership as per that residency. The individual with an interest in the residency, beneficiary of a special trust, or a spouse that a person or a beneficiary must ordinarily reside in home, and it may be used for domestic purposes as his or her ordinary residence. The primary residence exclusions applies or also applies to the land on which the primary residence is situated, including unconsolidated adjacent land if the following conditions are met. The exclusions apply only to a maximum of 2 hectares. There must be a maximum of 2 hectares, not more. And the land must be used mainly for domestic or private purpose together with the residency. Those are the conditions or the specifications in regards to the primary residence. And the residence must be disposed at the same time to the same person as the land on which it is situated. The individual is also entitled to disregard as if the proceeds does not exceed 2 million. So 2 million rand is actually an exclusion. It's a limit. So if it does exceed 2 million as the primary residence, that means that you're going to limit the exclusion to 2 million rand. The other difference, it will be qualifying as part of your CGT calculations. So in such event, the taxpayer does not need to determine the base cost of the residency. This rule is not available under certain circumstances. For example, when the taxpayer has not ordinarily resident is not ordinarily resided in the residence throughout the period since the 1st of October 2001 and have used part of it for the trade purposes, certain claims have to be placed on that exclusions. So all you have to do is to determine part of the residency in terms of the taxpayer as to whether do they reside in that type of an asset for the primary residence or do they use it for business purposes. Right. So it further says that in terms of the exclusions, the exclusion will not apply to any capital gains or loss in excess of 2 million rand. To the extent that their gain exceeds 2 million rand, the excess must be taken into account as a capital gain. I gave an example there that if the gain is 2.5 million, 2 million must be disregarded by the 500,000. 500,000 rand will compromise a capital or comprise of a capital gain. All right. I think it's what I've just explained up there. The taxpayer may not claim the primary residence exclusion for more than one resident at a time. So it has to be one at that time, not more. And the exclusions will apply only to a capital gain or loss attributable to a maximum of 2 hectares of land. So that's the maximum there, not more, used together with the primary residence for domestic purposes or private purposes. And for the larger pieces of land or that land, it is not used for private or domestic purposes. The capital gain or loss must be apportioned. So you're going to look as to if that part of the land, is it specifically for private use or is it for residency? So is it for business? So sometimes they tell you that 50% of whatever the asset it may be was actually for private and the other one was actually for the business. So you just have to apportion that and take your 50% for the CGT and the other one will just go for the gross income or for the business. But the primary residence exclusion will reduce only the qualifying portion of the capital gain or loss. The exclusion will not apply to a capital gain or loss in respect to the period on or after the valuation date, which is the 1st of October 2001, when the person was not ordinarily resident in that primary residence. And the exclusion will not apply to a capital gain or loss in respect of the part of a primary resident that has been used for the carrying on a trade on of a trade after the valuation date. It further says that if the property is owned by a combination of natural persons and persons other than the natural persons, only the natural person can claim their portion of 2 million rand exclusions. So generally, a person is not entitled to more than one primary residence at the same time. However, same applies as when you cannot claim for more than one primary residence. Sorry about that. For more than one primary residence, a taxpayer will be treated as having been ordinarily resident in the primary residence if they are not ordinarily a resident during the period not exceeding 2 years for any of the following reasons. At the time the residence was their primary residence, it had been offered for sale and vacated due to the acquisition or the intended acquisition of the primary residence. The primary residence was being erected for land acquired for the purpose in order to be used as the primary residence. Further again, the primary residence had been accidentally rendered uninhabitable, for example, because of a fire. So that's actually a natural cause. Again, with the death of a taxpayer, this enables the deceased estate to claim the primary residence exclusion. Right, in terms of Section 86A, residence is treated as having been used for domestic purposes during any continuous period of absence while it has been left under the following circumstances. The residence must not be left for more than 5 years, and the taxpayer or the spouse or the beneficiary of the special trust must have resided in the residence for a continuous period of at least 1 year before and 1 year after the period of absence. The taxpayers treated no other residence as a primary residence during their absence. And they were temporarily absent from the Republic or employed or engaged in carrying on business in the Republic at a location further than 250 kilometers from their residency. Remember, those are the exclusions, and the person is only allowed to have one primary residence at a time. The reason for the rules listed above is that there may be an overlap of 2 years, resulting in a person having 2 primary residences at the same time. He or she can therefore claim the full exclusion for both. That's the 2 million. The disposal of a primary residence that falls within the joint estate of the spouse, married, and community of property is treated as having been made in equal shares by each spouse. The primary residence exclusion will be apportioned between 50% for each. If more than 50% of the primary residence is used for trade purposes, the taxpayer will not qualify for any residence exclusions, as the residence is not used mainly for domestic purposes. Right, while in the study, the above you should note the following. The maximum amount of the exclusion is 2 million. I think we've spoken about this. But if one of the exceptions exists and the portion does not qualify for the exclusions, if the running cost of the house is claimed as a business expense for the income tax, the portion of the gain disposal of the property does not qualify for that exclusion. Right, personal use asset. Most personal use assets are excluded in order to qualify as a personal use asset, and the asset must be used mainly for non-trade purposes, which is more than 50%. Examples of the personal used asset are as follows: jewelries, artwork, household furnitures, antiques, private motor vehicles not used mainly for business, or microlight, aircraft, or a hang glider with a mass of 150 kilogram or less, and a boat that is 10 meters or less in length, stamp or coins collections, but excluding the gold and the platinum coins, whose value is mainly derived from the metal content. Right, so the following assets are used for the purpose other than carrying on of a trade will not be classified as a personal use asset. Is an aircraft with an FT mass exceeding 450 kilogram. This would exclude it, for example, a hang glider or microlider. You can think of explain this part. And a boat exceeding 10 meters in length. The purpose of the 10-meter cart is simply to exclude small pleasure craft such as rowing boats, sky boats, small yachts, rubber dines, and the likes, which are unlikely to yield capital gains on the disposal. Okay. I know that this theory might be a little bit too much for you, but the intention is to prepare you for the second year or the third year, because it's going to go more in a broader knowledge where you have to understand everything, writing it down, right? For example, if you're given a scenario where you have to explain as part of the required, these will be required for you to know. And then if you're guessing, you're going to have a problem. Okay, but at this point in time, some of the theory are just included, but much of the theories are not going to be used in here. And I think you'll see that when we do the questions. Fiduciary, usufructuary, or similar interest whose value decreases over time. For example, a husband who dies and leaves the bare dominium in his holiday home to his son and the right use to his wife for the rest of her life. The list of immovable property, for example, holiday home acquired under the 1899 lease, timeshare and share block interest with a fixed life whose value decreases over time. Rights and interest in the above assets. Coin made mainly from gold or platinum, of which the market value is mainly attributable to the material from which it is minted or cast. Only the capital gain of this will include in the aggregate capital gain or losses on the disposals are disregarded. Retirement fund benefits, we dealt with this, which are benefits paid in a lump sum that are disregarded in determining any capital gain or the losses. Right, let's look at the disposal. This is very important. I think I've seen one of the questions in regards to this. Disposal of a small business asset on retirement. Where a person sells a small business, SARS allows an exclusion of the capital gain on the asset up to a maximum of 1.8 million rand during the person's lifetime for capital gains tax when calculating the aggregate capital. Okay, this is what happens. Some people, they own small businesses. Obviously, that creates a goodwill with it is an asset for the business. When you dispose that small business, the maximum exclusion, or it will be or limited to 1.8 million rand. But should it be greater, that means the difference is going to be, or is going to arise what's called the capital gains tax. So the amount of 1.8 million is per person. Thus, if the couple is married in community of property, would each be potentially entitled to 1.8 million exclusions, provided that they are within the requirements. All right. So you need to look at the marriage type of the taxpayers. If they're married in community of property, then that means each individual will be entitled to 1.8 million as per the type of the marriage that includes the 50/50. The disregarded amount applies only to capital gain and capital losses. So gambling games and competitions, all capital gains and losses arising from gambling games and competition will not be subjected to CGT. Right? This includes all the manner of the activities such as the horse racing, national lottery, casino winnings, and the high. It is immaterial whether the winnings are from there are in the form of a prize or the cash. So sometimes the gambling can be in the form of you win an item, not necessarily the cash. So, but however, it does not actually result or bring the determination of the CGT to it. They are actually excluded. So that would include the other things like soccer gambling, whatever that you may name it, as long as it is actually a gambling. Donations and bequests to public benefit organizations. Any capital gain or capital loss is determined in respect of the donation or the bequest to public benefit must be disregarded. Right, so limitation, remember that's a donation when you are dealing with the CGT. It's not an independent donation when we're dealing with the taxable benefit or taxable calculation. Limitation of a capital loss. Certain capital loss cannot reduce the aggregate capital gain or increase the aggregate capital loss to be carried forward if they were not used for the purpose of trade. SARS exclude the capital loss on the disposal of the following asset if the taxpayer did not use the asset for trade purposes. Is your aircraft exceeding 450 kg and a boat exceeding 10 meters? I think we covered that up there. So you need to take note or consider this. If there's a gain on the specific aircraft or boat, the gain will be taken into account. It is only the loss that is ignored. So in meaning that if you're disposing the aircraft or the boat, if there's a gain there, obviously going to be taxed 40%, and then if there's a loss, it's going to be ignored. Transfer of asset between the spouses under the Section 9 HB. There is no capital gain tax if the assets are actually transferred in between spouses. But before I go on to the question here, let me bring you up to speed. Any questions? Do you know? Any questions regarding the CGT?
No.
No questions. Ogezo? Ogezo?
Oh.
All right.
No,
Anzani?
no questions.
No questions. Anzani?
No.
No questions. All right, so that gives me the power to actually continue with question 7.2 from the guide. Right, the question goes as follows. It says that Andy Lebalo is 24 years of age and takes part in the National Lottery from time to time. In October 2021, he was very lucky to be the only one to be selected, to select the correct numbers. His prize money amounted to 19.8 million. Andile immediately decided to move to St. Helena Bay. He wanted to buy a piece of land with a 6-bedroom house and all-round views of the ocean. After a couple of weeks, he met Patricia Plucky, who owned just the property he was looking for. After some negotiations, they agreed that Andile would buy the property from Patricia with an amount of 6,250,000 rand. Patricia is 68 years of age and has never been married. She bought the property in 1995 after she retired and has been living there ever since. The valuation date value, which is assumed to be correct, with an amount of 2,880,000 rand. During 2010, she built 2 swimming pools, one on the other side of the house, and they're both heated. Okay, and the total cost of building these pools was 261,000 rand. At the same time, she painted the house with an amount of 453,870 rand. When she sold the house, the outstanding amount on her mortgages was 368,000 rand. Required to calculate Patricia's taxable capital gains or loss for the current year of assessment if she did not have any other disposals for the year. So my question to you is, when you see this kind of a question, because I assume that you guys have, what do you call it, have approached this kind of a question. So when you're approached up this, when you're faced up with this kind of a question, what would be your approach? This is going to be how you approach the question. You're going to have the profits, and then you're going to have the base cost. Right. So your profit will be your disposal. The base cost will be how much have you purchased. Your, what do you call it, the residence worth. Okay, let's go back to the question again. I'm going to go to line item number 2 or 3. You wanted to buy a piece of land with a 6-bedroom house and all the round reviews of the ocean. After a couple of weeks, he met Patricia Blackie, who owned just the property he was looking for. After some negotiations, they agreed that Andile would buy the property from Patricia for 6,250,000. Right? So the other thing that you must just consider here is the question specifically tells us that we need to look at the capital gain or the loss for Patricia, not for Andile. What means that everything will be considered under Patricia. So Patricia is 68 years of age and has never been married. She bought the property in 1995 after she retired and has been living there over the years. Valuation date value, which is assumed to be correct, that's going to be your base cost. During 2010, she built 2 swimming pools, one on the other side of the come on. But during 2010, she built 2 swimming pools, one on the other side of the house, both heated. She built the swimming pools because she wanted to have a view of the sunrise and the sunset while sitting in the pool. The total cost of building the house with the swimming pool is 261,000. At the same time, she painted the house with an amount of 453. When she sold the house, the outstanding on a mortgage would be 368,000. Okay. Just going to check something quickly because I'm looking for the process basically. After some negotiations, they agreed that Andile would buy the property from Patricia for 6,250,000 rand. That's a disposal. So basically what you're going to do is you're going to say 6,250,000 rand as your disposal, as your profits. Sorry, I forgot that amount. It's 6,285,000, right? Go back and check. 6,250,000 rand. My apologies. So that's your process. You see on how easy these things are. And the base cost, it would be valuation date value, which is 2,830,000. 2,830,000. 2,830,000. Okay. Then you're going to deduct your base cost. You must just show in the bracket to ensure that you are going to include that. Right. So let's look at the other things that will be included in there. There was a swimming pool there with a loan and painting. Right, let's just have a look at swimming pool. So remember, that's part of the cost. It is included, yes, it is included. And there was a loan amount. Remember the borrowing cost part? Not included. So you can just say excluded. And obviously you're going to have a nil. And there was a painting. Is it included? Excluded? Out of the cost? And then you're just going to say no. How much? We're going to look at how much was our swimming pool cost. The cost of the building, the base of the pool is 261, so it's going to be part of your valuation date value, which is a base cost. And then you're just going to put it in the brackets, 2,000 rand. And then you are going to get what's called the gain, right? How much is six? Can somebody help me quickly if you've got a calculator there? How much is 6,250,000 minus 2,890,000 rand and minus 261,000 rand? Please help me quickly. You have got 3,159,000. That would be my capital gain. Uh, 3,159,000. Okay, and then we're going to look at the primary residence exclusions. You remember the 2 million. Residence exclusions limited to 2 million. Going to be like that. So you are definitely going to have 1,159. Your total capital gain, it will be, I think it's 1,159. 0. Okay, if you are actually there, just let me know if I've got the correct amount, the right amount. And then you're going to have the annual exclusion, which is limited to 40,000 rand. My apologies, I didn't want to put that there. Annual exclusion because they are natural peasants. Annual exclusions, it's limited, it's always 40,000, right? And you put it like this. So how much is 1,159,000 minus 40,000? Guys, please help me. Anybody with a calculator quickly?
1,119,000.
1,119,000. Thank you. 000. Then you're going to multiply that by the inclusion rate, which is 40%. Or always of 40%. Always our capital gain is calculated at 40%. How much is 1,119,000 multiplied by 40%?
447,600.
447,600. That's your taxable capital gain. 447,600, right? They'll put the correct amount.
Yes.
Okay. Capital gains tax. Is it bad? Let me bring you up to speed. That brings us to the end of our first question. Is it that bad, or are we getting it right? Who find it difficult so that I can re-explain it again? You know, are you fine? You know? You know, it's quiet. Lebogang, welcome to the class. You just found us doing the capital gains tax. So we were done with the theory, now we are doing questions. Welcome to the class. Are you winning that? Is there anything that you would like to ask before I move on to the next question?
No, not at the moment, sir.
Okay,
Thank you.
but are you done with your theory part on CGT?
No, I haven't started lesson 7. No.
Okay. But Kogetsu, are there any questions, my dear?
No, sir, I'm good.
Are you good? Anzani,
Yes.
are you winning?
Yes.
Are you winning? But did you manage to touch base on your CGT theory?
No.
Or you haven't touched on it?
Yeah.
No, you guys must just give it time. I don't think it is actually that bad. Okay. So whenever you are actually encountering problems, let me know so that I can be able to assist you. Okay, so we're gonna move on to the next question. And I'm gonna give you about 10 minutes break. We'll be back at 10 past. And then we'll do question 2. It's a CGT question again. Right, you can just check on your study guide. It's 7.3. Then we'll be able to do that kind of question together. So this time around, we'll be dealing with multiple assets. We're not going to deal with specific assets. So that means that we're going to calculate the capital gains check separately. All right. Have a look at how does it look like, and then we are actually going to do it all together when we come back at 10 past. So let's have that T. All right, let's look at our second question here. It's 7.3 in the study guide, as I've mentioned. So it says that Betty Brave is 55 years of age and lives in KZN, KwaZulu-Natal. During the current year of assessment, she sold the following asset. Number 1, which is a primary residence situated in Margate, sold on the 1st of January 2022, and the selling price is 5 million rand. On the other information, Betty purchased the residence on the 1st of July 2008 for an amount of 2520, and the estate agent commission to the sale of was 45,000 rand. Asset number 2, we've got a holiday home situated in Umhlanga Rocks, dated sold the 15th of February 2022 with a selling price of 925,000 rand. And the other information says Betty purchased the residence on the 1st of January 2001 for 250,000 rand. Sorry. The house was privately sold, and the improvements made of 150,000 were made during 2009, and the market value is 350 on the 1st of October 2001, while the time apportionment base cost was 222. Asset number 3, it's a motor vehicle, sold date 20th November 2021 with a selling price of 20,000 rand, and the other information says that she purchased it on the 1st of March 2010 with an amount of 250,000 rand. Required, calculate the taxable capital gain or loss for the 2022 year of assessment. All right, I gave you the approach initially. I said that when you approach this kind of a question, despite whether the amount is going to be wrong or right, the first thing when you are required to do the capital gains tax, it's you need to put your proceeds, and then you put your base cost, and then you get your gains, and then you're going to look at other exclusions if they are there. Right. So when you look into that question, what did you identify in the first asset? Anything that you have identified? Right. Asset one. Which is the primary residence. Residence. Okay. So you're going to have proceeds. And base cost. How much is the proceeds, guys? How much? Did I see your hand?
No, it was when you were asking if ever we are back.
Okay, no problem. Okay, what would be the process there? What would be your proceeds? What would be your sale?
Sir,
Yes, Koketo?
I think it's 2,520,000.
But that's the base cost. That's what we have purchased the asset with. How much have we sold the asset for? How much was the primary residence disposed with? 500,000, right? Okay. And then your base cost will be 25,20,123. And there was an estate agent commission. How much was the amount? 45,000, right? Actually, capital gains tax is actually one of the easiest content in this. It's one of 501. All right. How much is your total base cost? 252,000 plus 45,000. How much does it give you? Come on. How much does it give you? That's 252. When do you have calculators? Two five two triple zero plus 45,000. Can somebody give me that figure, please?
256500.
2565,000. Thank you. It's a 000, right? That's going to be your total base cost. And how much is the difference between 5 million and 2565,000? That'll be your taxable capital gain. How much is it, Anthony?
2435 000.
2435 000. Okay. Primary residence, what do we do? What do we do in the primary residence? The exclusions. Limited to how much? 2 million rands. Make sense? Inclusion rate, always at 40%, right? So how much is, I think it's 435, if I'm not mistaken. Then you'd say inclusion rate. Inclusion rate is at 40%. How much is 435,000 multiplied by 40%? Let me just find my calculator quickly. 435,123 multiplied by, not from 40, it's 174,000 rands. Everybody happy? Everybody happy? Sorry, are we all clear on that? Where's the energy?
Yes, sir, we are clear.
All right. Oh, there is no energy this morning. Okay, that's your second part. Okay, let's do this. Just a moment. Make sure that's it too.
Sir,
Yes, ma'am.
can you please go up from the answers?
Okay. Here I am. Okay, so are you there?
Yeah, I'm okay. You can remove. It's fine.
Is it fine?
Yes.
All right, hazard number 2 is a holiday home.
Oh, we have wash. Mamak.
Eh? The what? Don't worry, you'll be fine. You'll be fine. You'll be sorted. All right, let's have a look at asset number 2. It's a holiday home situated in Umhlanga Rocks. It was sold on the 15th of February 2022, and the selling price is 925,000 rand. On the other information, Betty purchased the residence on the 1st of January 2001 for 250,000 rand. Okay, so this is one of the things that you must just consider. The date. Okay, meaning that we have to determine the valuation date value. It was actually sold before the 1st of October 2001, and the house was sold privately with the improvements of 150 were made during 2009, and the market value was 350,000 rand on the 1st of October, while the time apportionment base cost was 222. Right. Okay, so since you already know one more, can you highlight me? Can you help me? How much is the proceeds? How much is the proceeds? Okay.
Sir, I think it's 250,000.
250,000 rands. And then why did you say that?
Because they said that she purchased the resident on 1 January 2001.
Remember, the process is a disposal. It's not a base cost. It's not a purchase cost. So it's, yeah, your process is always the selling price.
Okay.
Yes. So it should be 950. Can you see that? Can you see that, everybody? It will be 950,000. And we're now going to determine what's the base cost. I think that's where you are. Okay, so base cost. So you'd say asset was purchased prior the 1st of October.
Okay.
Let me just finish up with this. I'll be with you just now. Therefore, we need to determine the valuation date value. And the bigger question is, what is valuation date value? That will be your base cost. The greater between market value the greater between market value the 20% rule, and the time apportionment based cost. All right, our tab is given to be 222, and we don't have the 20% rule here, because we're not given the process to determine that, and the market value not given. Not given as well. So meaning that we're now going to look at which one is greater than which here. Right. The market value has been given with 350,000 rands, and then the tab is given as 222. We can't consider the tab because it's lower than the market value. So your base cost would include the market value plus the improvement made from that house. That's your valuation date value. So you can further say valuation date value is the market value plus improvements. Made on the holiday home. Right, which is going to be 350,000 plus how much was the improvement? 150,000. Plus 150,000. So it should be somewhere 500,000 rands. Do you agree there? Equals 500,000 rands. So that will be your base cost. How much is 950 and minus 500,000, right? I think we've got about 450,000. Am I correct? You follow, guys? Do you follow? So that will be your gain on a holiday home. I think here I made a mistake. It is supposed to be 925. My apologies. That must be correct. So the gain on the sale of the holiday home, it's 900. So it's 925 minus 500 is about 425. Okay, hold on. I think one of the students is calling. So your taxable capital gain it's 425,000, right? Right. What do we do next? What do we do next? What do we do next? Okay, we bring the inclusion rate at 40%. So 425 multiplied by 40%, how much do you get there? 425,000 multiplied by 0.40%, of course, 170,000, right? Right, so there will be your taxable capital gain. Can you guys see on how this thing is treated? You guys there? Okay, you guys there? All right, let's have the last asset, which is the motor vehicle. So the same process will be followed with your proceeds. When you less its cost, then you get your gain or taxable gain. Right, I said the motor vehicle date sold the 20th of November 2021. That's after the 1st of October 2001. Selling price 20,000. Other information, she purchased it on the 1st of March for it's 200,000 rand, and then it was purchased for 250,000 rand. And your proceeds will be 200,000 rand. And your base cost, it will be 250,000 rand in the brackets. Right, so we've got a loss here. We don't have a gain. So capital loss is 50,000 rand. The question is, do you include the 40% if it's a loss? No capital. Gains at the inclusion rate of 40%. On a capital loss. Okay. Then you do what's called the aggregate. Aggregate. Remember, it's multiple asset. Capital. Gain or loss. The first one is a primary residence. The second one, it's a holiday home. The third one is the motor vehicle. Motor vehicle, and then you take all of these amounts. Here it's 50,000, which is a loss. You put it here, and then we're going to look at how much was the capital gain for the holiday home, as well as for the primary residence. I've got 435, it's supposed to be 174,000. So for the primary residence, it's 174,000. And we have to look for the holiday home. It's asset number 2 is 170. I think I made a mistake, but I'll correct that. Okay, so verify. You guys following? Anzani, are you following?
Yes, sir.
Great. Okay, the mistake that I did, it's actually on the finalized, actually this is where I was supposed to end. Okay, I was supposed to say capital gain, capital gain, 435,000. And on the second asset, this is supposed to be released, is 425,000. Let me just go back. Just want to check out something quickly. 435. But remember, it's a combination now. 435, 1 and then you're going to have what's called aggregate capital gain. You say 435. Uh, 435 plus 425 minus 50. You'd have 810. Right, and then you're going to include the annual provisions. Hold on, I just want to check on something. Here, I think, okay, just like it doesn't have a provisions. So it doesn't have that. Cool. So the annual exclusion is, as we always, limited to 40,000. Right, and then inclusion rate at 40%. So what's going to happen is, I would say, because that the annual exclusion has to appear once on the assets, let's say 810 minus 40,000, 770,000. Then you multiply this by 40, you divide it by 100. So it's 308. Okay, times 710,000. Your aggregate capital gain is 308,000. So that gives us the final figure. All right, we're going to go back a bit. I've developed some other independent questions. I think there are 2 or 3 here, and then we'll just wrap up things. Just secretly, it's 3 questions. Hold on for me, please. Before I move on to the next question, do you guys need clarity on CGT? But I think you guys need to study it more. I don't think it is. It's no longer my responsibility. I think you guys have to go do your theory and practice questions. Do we agree on that? Do we agree on that? Do we agree on that?
Sir,
Yes.
what are we supposed to agree on?
The CGT. You guys are not comfortable with the CGT, and it's simply because of you haven't studied.
Yeah.
So you need to go back and redo your work. Okay. And you'd let me know, because even the basic, the easiest thing, the framework where you have to write your own proceeds and the base cost, you guys are actually getting confused. You're not being participating as compared to the other part. Okay, without any waste of time now, let's have a look at the independent tax questions. I picked up this example in your guide. It actually includes the right use of the company owned vehicle. Okay. It includes this part. And the reason why I'm including it is because of, I think we only did just a piece of it, not that much of it. And that's why I actually brought it back. All right, it says that Novania received the right to use the company owned vehicle on the 1st of March 2021 and used the vehicle for the whole year of assessments, which is 12 months period. The employer is not a manufacturer or an importer or a dealer or a rental company. Nevonia, employer purchased the motor vehicle new on the 1st of March for 337,500, including the VAT. No maintenance plan was included in the purchase cost of the vehicle. The company is responsible for the maintenance of the motor vehicle. The employer is therefore responsible for the services of the motor vehicle and any other way and sheer cost. Required says that calculate the taxable benefit from the private use of the motor vehicle that need to be included in the scores income for the 2022 year of assessment. The approach, how do you guys approach this kind of a question? What's your approach like on this kind of a question? How do you determine the company use of the motor vehicle?
Sir,
Okay, so I think this is your thing.
let me try. I'm not sure.
Awesome belief.
Sir,
Yes.
I think you're going to write the right of use of motor vehicle.
Right use. Okay, let me just follow you just a moment. Hold on a second. I just want to go to the question quickly. Okay, I am with you. I'm going to write the right use of the motor vehicle. Yes.
After you write the determined value.
So I'm going to do the determined value.
Yeah, determined value.
Determined value. Determined value. Right.
And I feel the answer it's 337,500.
337,500. Like this.
Yeah.
Okay. Are you fine?
And, sorry?
Okay, can you go ahead?
And less depreciation.
Depreciation. Okay, I'm going to put the went here because in text we use the went here, right? How much is the depreciation?
Say, can you please go up again?
Okay, to the question. I am here the question.
Sir, I think because we include tax, it's going to be 337,500 multiplied by 15%.
Okay, let me just see. So listen to what she's saying. 337. So that's the, is it the went here?
Yes.
Okay, multiply by 15%.
Yeah.
Okay. Give me the figure there quickly.
It's 5625.
50625.
Yes.
Okay.
You put it in the bracket.
Okay, it's 50625.
Yes.
Okay. 50625. I got you.
Then you're going to say 337,500 minus 5020 625.
Okay, that's the carrying value, right?
I don't know.
Okay, what are you getting at? How much is it?
I'm getting 286,175.
375.
Yeah, 2868. No, like 286,875.
28. Okay, did I write it down nicely, correctly?
Okay.
286375.
It's 286,875.
Is it 286? Give it again, please.
837. It's 286,875.
But that's a lot of figures.
Yeah, like. Sorry?
That's a lot of figures.
Yeah. Say,
Yes.
can I ask something before ne?
Yes.
3.25%. We use when what happened?
When there's a maintenance plan.
Can you please go up again?
To the question.
Yeah, to the question.
Okay. All right, here's the question, Cookie.
Yeah.
Are you fine?
Yeah, say, yeah, go back to the answer.
Okay.
So we are going to say reduced by 3.25%.
So let's start by rectifying your figure. 2868375. It's actually incorrect because it's greater
Sorry?
than the figure that you have arrived for. The carrying value,
Yes.
it's incorrect. It can't be million. We are dealing with thousands.
So let me see something. Maybe I made a mistake while I was
Doing the calculations. I get you. You can check that.
Can you please go up again?
Okay, no problem. Here I am.
No, so I think I'm correct.
No, okay. All right. No, let's assume that you are correct. How did you get to
Okay.
286?
Okay, let ask someone to calculate it for me, please.
Okay, how did you get to 2868375?
I said 337,500 minus 5625.
Yeah, but 3375 is 1,000, is 337,500. But your carrying value is 868,375. There's no correct correlation in terms of your figures. That's what I'm trying to say. Your carrying value
Oh yeah, sir, you're correct. Sorry, sir, I made a mistake. Can I please say it again?
Okay.
Can you please, remove, it's 286
286
875.
875. Now
Yes.
we're getting somewhere. Yeah, now it makes sense.
So can I proceed?
You may proceed, my dear. You may proceed.
So you're going to say reduce by 3.25%.
3.25%.
Yes.
Okay, so are you going to say 286 875 multiplied by 3.2%? 3.5. It's a 3.25, right?
Yeah, 3.25%.
Okay. And how much are you getting?
Can I please?
Now you just have to calculate this. 286 875 multiplied by 3.25. That's what I want to get now. How much is your final figure?
My final answer is 9323.
9323.
Yes.
9,220. 9,323.
9,323.
Okay. Let me just verify that on my calculator. It's 286.
Yeah,
It looks
because
like
when I'm coming to calculations, I'm bad.
okay. 286 875 multiplied by 3.5. Also 26 is it okay? 2868 775 multiplied by 3.25 divided by 100. 9323. There you are very correct. Okay.
Thank you.
All right. Well done so far, Kogetsu. My concern, because we're looking for the the right use of the motor vehicle. You don't have to calculate this. This is my concern about your process is fine. You get what I mean? And obviously your carrying value would be incorrect. And then I'm also concerned about this because it seems like you are more confused about the inclusion of 3.25 or the 3.25. However, because there's no maintenance plan, we just have to go straight to 3.5%, not 3.25%. Here is the key
I should
issue.
go to what?
3.5%, not 3.25. The 3.25, it's when there is a maintenance.
When there is what?
When there is a maintenance.
And then the 3.1, what was the 3.1 what?
3.25, it's when there is a maintenance, and 3.5, it's when there is no maintenance.
But say the information saying the employer is responsible for the maintenance of the motor vehicle.
Yeah, but they didn't sign up for the maintenance. That's why it's saying no maintenance plan was included in the purchase cost of the vehicle.
Oh.
Yes.
Okay.
Makes sense?
This thing is really hard. Hey.
Do not be confused about when this, because they try to trick you in most cases. So just make sure that you are actually following understand what the question says, basically.
Okay.
Okay, so let me just show you the corrections. The determined value will be 337,500. So you say 337,500 multiplied by 3.5%. And then you multiply by, because it's for 12 months period. And that's how it's going to be. The final figure would be, I'm just going to calculate that for you quickly. 337,500 multiplied by 3.5 divided by 100.
Just imagine.
Multiplied by 12 months. It's 141,750. Okay, so you follow it?
Sir?
Final figure will be, the determined value will be 141,750. You just take the cost, you multiply by 3.5%, and then you multiply that by 12 months, and then it will give you the final figure. Are we clear?
Yes.
All right. Anybody who need clarity here? Let's see, Kalina. Sorry, Anzani. I'm confusing with Anzani. Are you following my sister?
Yes, sir.
All right, that's great. Lebohang, are you still with us? Lebohang? Lebohang Poto. Lebohang is so quiet. All right, I'll take it as Lebohang is actually following. Right, we're now in our final installment of the final hour of our class for today. So it's going to run for the last 1 hour. And we're going to continue with the questions that we have. Should we have more time, then that means we'll have to go back and look at some of the questions and then we'll tackle them together in the tutorial later. But example 5.2 goes as follows. Refill will receive the right use of the company-owned vehicle on the 1st of September and the use of the vehicle for the rest of the year. That's 12 months period. The employer is a retail shop. Refueler employer purchased the motor vehicle on the 1st of September 2021 for 280,000 rand, including the VAT. The reason, can you see the difference now, Kogetsu? There's a maintenance plan for 3 years for 60,000 kilometers, which is included in the purchase price of the vehicle. And then the employer is responsible for the maintenance of the motor vehicle. I think this question was supposed to say the employer is actually not responsible for this. But let's look at the required part, which it says that calculate the taxable benefit from the private use of the motor vehicle that needs to be included in previous gross income for the year of assessment. Anzani, do you want to attempt this for me? Let me bring you up to speed. Let's test you since well you're fine. Anzani?
Yes.
All right. Please attempt it for me, my dear sister.
What's
your approach?
Try.
Please try.
Right. Determine the value of how much? 280,000.
280,000, yes. So we're going to write determine value. That's what you said, right?
Yes, sir.
280,000. Right.
And then we're gonna times it by 3.25 because there is a maintenance plan.
Okay, because there is a maintenance plan, 325%.
And
then just a little piece. I think you'll be done. You're left with one thing. I'm giving you a hint. Hello?
okay.
Times.
Let me read the question first.
Come again.
Let me see the question first. Can you please go up?
Let me go up for you quickly. Here's the question. All right, let me give you another hint. What do you do if it's given for the rest of the year?
It's gonna times it by 12 months.
We multiply by 12 months. Yes. Okay, please finalize your answer. How much is the final figure here? How much is 280 multiplied by 3.25%?
109,200.
in 119,200.
109.
Or 109,200. That's your final figure. That's very much correct. Okay. Okay, so are you following? Okay. Let's go get. Yes, are you following?
I'm following. Yeah.
All right. All right. You just need to know as to when do you use 3.25 and when do you use 3.5%. And then the other important factor is when was the car given to. It might be given 8 months before the year of assessment.
Sir,
or it might be,
sir, can I please ask something? Sorry for the interruption.
no problem.
Sir, ne? I wanna do something, ne? If I
Yes.
said 280,000 multiply by 15% multiply by 12 over 12, ne?
Yes.
I get the answer. Then I take 325%, ne?
Yes.
Multiply by the answer that I have gotten there. Am I wrong?
Yes, you are. You are wrong with the
Okay.
locus. Let me tell you where you are wrong, because you are trying to adjust the VAT that is included. And remember, the VAT, it's part of the cost.
Oh, when they said exclusive, that's when I should include the VAT.
That's when you have to add it.
What?
That's when you have to add it back.
Okay, no problem. I understand. Now I know the difference.
Yeah, and if they tell you that it must be included there, but that is always part of your cost. The only thing that is not part of your cost, it's your finance or the borrowing loan. Interest in the borrowing cost and stuff like that, they're not forming part of your cost. But that must be included. No, I get why you were actually getting it wrong, because you needed to start with the 15% of the VAT, right? And add it there. So if you add it, it means that you are adding it twice, double counting of that in the cost, because it's already included.
Okay, I guess I have to read more theory.
Yeah, you have to go through to your theory.
Okay, thank you.
Okay, everybody happy? All right, if you do question or example 5 point, I think it's about 5.3 going down, you are going to have a better understanding of your wear and tear. When do you calculate the wear and tear? But it deals mostly with the previous year, not in the current year. So you just have to go there and do those examples, 5.1, 5.2, and 5.3. It should give you an idea as to how you're going to do things. And you're going to read on the cost. Remember, the 7 years is actually there as well. And then the cost amount is limited to 595,000. Do not forget that. And read the maintenance plan, right? So read the maintenance plan, whether it's inclusive or it's not inclusive, all right? Included or not included, all right? And then read when you are going to calculate the wear and tear. So the wear and tear, we all know, if they give you anything below 7 years, you can take it as it is. And then if it's actually 7 years, you can just say, if it's more than 7 years, you must just limit that to 7 years. Those are the things that you are going to deal with. So every time, let me tell you something that would actually take you far in understanding this. Every time when you are given a certain example and then you are dealing with it, what you're going to do is you're going to read that question. You're going to note these things down. Number one, it's VAT included. If it's included, then it's fine. It's going to be part of your cost, right? So there is no adjustment. Number two, when was the asset purchased? Do I have to calculate the wear and tear, right? Number three, my wear and tear is limited to 7 years, not more, 7 years or below. And then number four, my cost is limited to an amount of 595,000. Number six, finance cost is not part of the cost. Do we agree with that? And then that's when you're going to establish as to, am I going to include 3.5%? or 3 point, because those are the only things that are going to trigger you. 3.5 or 3.25. And then lastly, identify when was the car given to the taxpayer. Is it for full 12 months period? Because you're going to multiply that by 12 months. Is it apportioned? Meaning that, is it less than 12 months period? So they're going to be very specific in the question. They will tell you, remember, the year of assessment in tax is not it's not like in accounting. In tax, it's always on the 28th or the 29th of February. All right. So let's say the car has been given in December at the beginning. You are only going to multiply that by 3, not full 12 months. But they will tell you whether it's for full year of assessment or it is actually for certain months. And then you're going to multiply that by that number of months. All right. So like I said, if you do question 1, and sorry, example 5.3, so example 5.1, 5.2, and probably 5.3, it should give you an idea as to redo them time and again up until you get it right. Do not leave them abandoned unless if you're tired and then you need a break. That's allowed. You can take a break and then come back to it. But what I'm trying to emphasize here is, as and when you're doing the questions, make sure that you note keywords down. If you're dealing with the first question, it says 3.25, and you have to look at, okay, what is the 3.25 for? Is the maintenance or the non-maintenance? Is it for full 12 months? Okay, the question says the full year of assessment. Right. Is VAT included? Does the question tells you that the VAT is included? All right. Finance cost, is it there? Do you get what I mean? Up until you get it right. If you do those questions, there's no way they can trigger you. Only those 3 questions. You will be able to do the question on your own without looking at the solution. Do them, look at the solution, identify the keywords there, the maintenance, the year of assessment, the number of years, finance cost, are they included there? All of those things. If it takes you to write with different pens, different pen color, then do so by all means, and you will be fine. Am I making sense? Am I making sense? People are still confused. All right, let's have a look at question 5.3. It is developed from your guide. All right, it deals with the travel allowance. We haven't touched on the travel allowance deeply, so that's why I brought this question as well. It says that Gerald received the travel allowance of 20,000 Rand per month. Okay, so this is one of the key issues that you must identify when you're dealing with tax. Per month, not per year. For the full year of assessment, another key issue here. All right, he traveled a total of 96,000 kilometers for the full year, 42,000 kilometers, which were for the private kilometers according to the notebook. So remember, we've got 3 items that you must deal with here. It's private kilometers, all right, and its total kilometers. All right, there's one aspect that is missing in terms of the kilometers. They're business kilometers we don't have, meaning that we are going to, I'm going to analyze this question one by one. We are going to need business kilometers. Okay. Since we've got the private and the total, we're going to need the business kilometers. Let me just highlight that in blue. Right, purchase price of the car is 575, including VAT on the 1st of March 2018. Right, so remember, what you're going to say is here, right, the purchase price does not exceed 595,000 Rand. Therefore, we're going to take for the car, the whole amount. Of 577,575,000. Right? So we know that you went here. We're going to use S limited to 7 years. Okay. Right, so there's a provision of the following expenses. We've got finance charges of 41,000, fuel cost 120,000 rand, and the license fees of 2,500 rand, maintenance plan of 12,000 rand. The required says that calculate the taxable income for the travel allowance. First thing first, when you're dealing with this kind of a question, table. Right, you're going to look at the table. Let me just go to my guide quickly. Just want to check the table. If you've got a study guide with you, I'm going to give you the page for the table. Just a moment for me. Table. Okay, the table that you're going to refer under this travel allowance, it's on page 23 of TAC 103. Okay. As soon as you've got the table, and then you have to calculate what is actually required. So when you calculate the traveling allowance, the first thing that you must do, you are actually going to look at the difference between the total kilometers travel and the private kilometers travel to determine the business kilometers. Okay. So here you're going to say, number one, total. Just a moment. Total kilometers travel, or you can just say total kilometers, and then you're going to have private kilometers. So how much is that total kilometers?
I think it's
96,000 kilometers. You're right. And the private kilometers is 42.
Yes.
How much is 96,000 kilometers minus 42? How much is 96 minus 42?
54,000.
4,000 kilometers.
Yes.
Right? Meaning that we have managed to determine how much is our business kilometers.
Sir, let me ask, if we are not given a private kilometers, what were we supposed to do?
You can't get to, you have to be given the two. It's either you're given.
If we are given
please go
if
ahead.
we are given total kilometers and business kilometers,
then we're going to say 96 minus 54,000 rand to get to the private.
oh, okay.
Yeah, you must always have the two. And if you're given the private kilometers and the business kilometers, you add them together, they will give you 96,000.
Okay.
Are you happy?
Yes.
Okay. Do you have any questions before I go further?
No, I think I will ask when you proceed.
Okay, as and when we proceed, right?
Yes.
Okay, no problem. What your second part would be, since we've got the business kilometers and stuff, so you're going to calculate how much is the travel allowance that you have received. Let's go to the question quickly. So the question says that Gerald received the travel allowance of 20,000 rand per month for the full year of assessment, meaning that he received 20,000 multiplied by 12 because it's for the full year of assessment. So you're going to say travel allowance. So I just want to remove the underline. Going to say travel allowance, and your travel allowance would be 20,000. You multiply that by 12. How much is 20,000 times 12? Somebody help me quickly. Somebody help me, please.
240,000.
240,000 rand. So that means for the full 12 months period, Gerald received 240,000 rand for the travel allowance. Yeah. Right. The second part here is we're going to calculate how much is the deemed cost and the actual cost. Yeah, if most of you would fail to understand this part, I would get it because it has a lot of components that you have to add and minus and stuff like that. Not what we did on the CGT. Okay, fine. Then we're going to calculate the deemed cost. That's the reason why we need the table. Deemed cost and the actual cost. Right. So there's a use of the table that we're going to follow when we calculate this. What do you call it? The actual cost. So we're going to start with, let's go to the table quickly. Let's go to the table quickly. Oh my, just a moment. All right, what's the table on page? Okay, hold on for me. I'm looking for the table. I'm going to give you the page number quickly, just a moment. I think it's page 28, but let me verify that. I want everybody to go there. Tab 103, open it, and go to page 23. Yes, I am right. Let's all go to page 23. Are we all there? Are we all at page 23? Or please talk to me. Are we all at page 23?
Yes.
All right. So basically what is going to happen is you're going to determine the fixed cost, and you're going to determine the maintenance, and then you're going to determine the fuel, and then we convert it to the rands. Okay. So let's look at how much is the cost of the vehicle. 157611. How much is the cost of the vehicle? Let me just quickly go to the table for you, because I keep on going back and forth here. Just a moment. All right, the cost of the vehicle, remember, it's 575. So if you go to the table, line number 1, it doesn't match. Line number 2, it says 95, but does not exceed 190. Line number 3, it says 190, but does not exceed 285. Line number 4 says 285, but does not exceed 380,000 rand. And the line number 5 says 380, but does not exceed 475,000. And line number 6 says 475, but does not exceed 570. And then line number 6 says 570, but does not exceed 665. So the cost of our vehicle is 575. Okay. So this is what is going to happen. You will say you're going to take all these columns that fuel cost, sorry, fixed cost and fuel and maintenance. Under the deemed cost, you're going to say fixed cost, fuel cost, and maintenance cost. But please pay attention. Right, the maintenance cost and the fuel cost does not require an adjustment, so you just take them as they are. But we've identified that we have to use that second line before the last one, which is the fixed cost is 156711. It is to say 157611. Right, we're still going to adjust that, and then the fuel cost. Let's have a look at how much is the fuel cost. Fuel cost is 172.4, right? So you just say fuel cost, then you adjust it here, 172.4. And then lastly, we're going to look at the maintenance cost, which is 99.6. Maintenance cost is 99.6. and 9.6. Right, now we're going to adjust it, right? So we'll just have to look at the question itself because we've got those ones. Then what we do is we look at how are we going to convert that. I'll show you now on how you're going to convert that. Just a moment for me. Right, the conversion would be in this way. You're going to say the fixed cost, you take that amount and then you divide it by the total number of kilometers, right, which is 96,000 Rand. So what you're going to do, we'll say this divided by 96,000 Rand. That's the total kilometers traveled, right? And how much you're getting? Somebody help me quickly. How much is 157611? Let me just confirm if this is the right figure. In the meantime, help me. 157661. So 156711. Sorry, 156711. 156711. And then you divide that by 96,000 rands. What are you getting? Then you multiply that by 100. Oh, guys, you're not done with the calculations. I know, do it. One 56711 divided by the total kilometers, and then you multiply this by 100. You've got 163,24. Or you can just say 163,2. 163,2, right? And then you're now going to get the total deemed cost. And you now have to calculate what's called the actual cost. We go up a bit. Actual cost. Right, and then how are you going to calculate your actual cost? Remember, we are given different types of the list of the finance charges, fuel cost, license cost, and all of those. But the first thing that you must do is to calculate the wear and tear, right? Wear and tear. Okay, I've told you that it's limited to how much? 7 years, right? Divided by 7 years, right? So somebody help me quickly. 575 divided by, I think it's 575,000, 5 million. So you'd say, I'm just going to calculate that for you. 123 divided by 7 years, and then you're getting 82143. I'm going to round it off. It says 82142,8. So you're going to say 82143. Okay, and then the rest you're going to take them as they are because they are given here. Let's go to the question. We've got finance charges, we've got license fee, we've got fuel cost. Right, you can say finance charges, we've got fuel cost, and I've got the license fees. Right. Finance charges is how much? Let's see. 1,000, and then fuel cost is 120. Finance charges is 41,000, and the fuel cost is 120. 120,000. Let me go back and check the license fee, 2,500 rand. My license fee is 2,500 rands. Okay. Then you are actually done with your actual cost. Let's look if it does require an adjustment. Okay, then the total is 257,643. And then you're going to say the cost per kilometer is 25743 divided by 96,000 kilometers just to get the actual cost per kilometer. Right, so you'd say 257,643. That's the total. 257,643. Right, and then you'd say actual cost per kilometer. It is going to be 257,643 divided by 96,000. That's your total cost per kilometer. Sorry, the total kilometers, right? And then you're going to say 257. Just a moment. I just want to calculate that. 257,643 divided by 96,000 kilometers. You've got 263, and then you can multiply that by 100. Let's see if it does fit. By 100. 268, comma 8. Okay, then let's look at our actual deemed cost. It's 163.2 plus 163.2 plus 99.6 plus 163.2. I think I'm missing something here. Let me restart over. 163.2 plus 172.4 plus 99.6. So I've got 453.20. That's the total. 453.20. Right. The reason why we calculate the deemed cost along with the actual cost, because we need to, when we calculate the travel allowance, we need to take the bigger figure between the two, right? So when you look at this, you definitely see that the actual cost is actually lower than the deemed cost, right? Let me highlight this quickly, just a moment. So our actual cost is standing at 268.38, and then our deemed cost is standing at 453.20. Okay, so we found the deemed cost being the highest, and then you're just going to tell me that just going to say deemed cost highest, therefore it will be used. It will be used, and it will be as easy as that. Right, let's go further to complete our question. We're now going to look at calculations of the travel allowance is 240,000 rand, and then we're going to less the business use, 54,000 kilometers, multiply by, right? I think this must be divided by 100. So you're just going to say 435.2 divided by 100 is 435 cents. And then you are going to say business use is 54,000 rand. You remember that's what we have adjusted on. But let's go back to the travel allowance itself. It's 240. And then you'd say less into this business kilometers allowance, which is going to be how much? How much is our business kilometers? 96,000 kilometers, right? Sorry, 54,000 kilometers. So you'd say 54,000, and then you multiply this by 5,453 cents. So how much is it? 54,000 multiplied by 453 cents, which is 244620. 244620. And you're going to look at the difference in between the two, and you're going to say you've got a difference of how much? That will be, the difference will be your taxable portion. So 244620 minus 240,000 minus 240,000, 4620. And there will be your taxable income. Four six two zero. Let me quickly look at the solution. I just want to check something. If our figures are matching, taxable portion is 5,100 in here. I'll tell you what's going on now. 54,000 multiplied by 4.234900 from 240,000. Okay, my figures are fine, unless if I didn't calculate things correctly. So you'd say 240 minus 234,900, or at least, yeah, I think I made it. The mistake here is 5.1. Okay. So that's how we end out our things. So when you travel, let me just give you a quick recap on the travel allowance. All right, the first thing that you must do when you calculate the travel allowance is you need to calculate either the total kilometers, the private kilometers, or the business kilometers. Once you're done with that, and then you're going to calculate how much is the travel allowance. So the travel allowance, you need to check is it given for full 12 months or is it given for certain months? And then you're going to take the travel allowance amount and multiply by that number of months. And you're going to say business kilometers allowance. So the business kilometers allowance is actually coming from the deemed cost and the actual cost. Right, and then why do we need the two? Is because we need to first calculate the business kilometers allowance. So we're going to look at the greater in between the deemed cost and the actual cost. All right, and then as soon as you are done with that in terms of the conversion, then you are going to take the business kilometers and multiply by the greater in between the deemed cost and the actual cost to calculate how much is the taxable income. But here's the thing. If your travel allowance is actually bigger than your business allowance, that means there's no taxable portion. If you're bigger than your travel allowance, that means you've got a taxable portion. Right, so let's see. Let's see you need clarity.
Sir,
Yes, okay.
you are saying that when the business kilometer, it's what?
When the business allowance, it's
Oh, the
greater.
business.
Yes, remember the reason for you to calculate the two between the deemed cost and the actual cost is to determine the greater that is going to be utilized to calculate the business allowance. However, if we found out that the business allowance is actually greater than the travel allowance, that means there is a taxable portion. But if the travel allowance is greater than the business allowance, there is no taxable portion. So you're going to put it in the brackets.
Oh, when the what is what again? Come again.
All right, we've got travel allowance and then we've got the business allowance.
I had that thing when you say when the business allowance is greater than the travel allowance, we have the taxable income.
Yes. And then when the travel allowance is greater than the business allowance, we don't have the taxable income.
Okay.
Yes. Are you fine? Okay, the other thing you have to note down is when you calculate the deemed cost and the actual cost. So remember the actual cost, usually that information is given. The only thing that you must just adjust to that is the wear and tear. So the wear and tear is actually or purely based on the cost of the vehicle. And you're going to divide that by the limitation of 7 years. It didn't give you any specific number of years for that. All right. And then after adjusting that, you're going to look at the cost itself. If it's greater than 595,000. And then if it's greater, you're just going to limit it to 595,000 rand. And if it's lower, you're just going to take that amount as it is. Like in here, we took 575 because it was lower than 595. Okay, so I'm afraid you would have this kind of a question in your assignment. There's no way you can't have it. You will have it. Any questions from Manzani? Kogejo seems to be fine. Manzani, are you okay? Manzani? Manzani, are you fine? All right, let's look at our final question where it says that we need to calculate the taxable income. You'll find this question in learning unit 6. I think it's one of the questions that we did on last week when we had, or this week when we had a class. It's actually from 6.2. I took the lighter one because I know most of us at this time when we are closing, we will be tired. So, but you can do more questions in that learning unit for yourself. Okay, so it's based on 6.2, right? All right, let's look at how it goes. Right, it says that you need to calculate the taxable income. First thing that you must just know, you start with your incomes. So your incomes, in this instance, your salary and your bonus. Okay, can you please go silent? All right, thank you. So the salary is 360,000. The bonus for the taxpayer is 25,000 rands. The process, so you're going to say your total income would be 360,000 plus 25,000, which is about 360 plus 25,000 is about 385. That will be your total income. It will come to your total income. Okay. And you're going to have it as 385,000 rands. And then you're going to look at the exempt. Remember we did this there during the week. No exempt. Okay. Then you're going to look at contributions. All right, let's look at the question itself. But Penny paid the following expenses during the year of assessment. There's a retirement annuity fund contribution of 3,500 rand. Then there's a donation to the PPO, where we received the section 18A received with an amount of 2,500. And there's a pension fund contributions of 28,800 rand. So the bigger question is, how are you going to approach that? Contribution to the retirement fund, there's 2 steps that you have to follow. So you're going to, your first step, it will be you are going to, let me just bring this here. You're going to calculate what's called percentage limit. Okay. What else? Anzani, Kogetso, what else are you doing? Step 1, calculate the percentage limit is limited to 27.5 of the greater of the remunerations. Or
Wait, I don't see anything.
no, I just need the process. You don't need the question there. You just have to give me the process.
The process.
Yes. It's limited to 27.5%. Yes.
And then the maximum cap of 350.
Remuneration. I'll come to that one. Maximum cap of 350. That's the other one.
Sorry?
Yes, the other one is 350,000. Okay, that will fall within your step 2, right?
Yes.
Right, and how much is the remuneration amount? We don't have that. So the taxable income is actually the same. So you'd say 385,000 multiplied by 27.5%. Okay. So it will be 385,000 multiplied by 27.5%. So how much is 385 multiplied by 27.5%? Somebody quickly help me. 385,000 multiplied by 27.5 divided by 100. I've got 105,875. That's what I have.
I got the same.
You got the same, right?
Yes.
Here is 105,875. So that's your step 1. Calculate the percentage limit, which is 27.5% of the greater of the remunerations or taxable income. Is the same. Which is the same amount of or the other thing is you need to calculate this. The step 2, you're going to look at the actual contributions, and then you're going to take the lesser between the cap. We're bringing your cap now 350,000, 105, and 385,000 rand. So let's have a look at the actual contribution.
Sir,
Yes, ma'am.
can you please explain this thing of a cap of 350?
Standard rule, it's given.
Okay.
It's like 27.5%. You can't come up with your own rate.
Okay.
Yeah. So it's you see on how this thing, you see on how easy this is.
Yeah.
Yeah, because you just copy and paste. It's 3.5 and 28,000. Hold on for me, please. 28,800, 3,500, and okay, it's 3.5 plus 8,800. Okay, that's for, I think it's for the RAF and the pension fund. It's the RAF and pension fund and pension fund. Okay, so it's so how much is 3,000 and 28,800? Anzani, I'm very much concerned about you. You're very quiet. 3.5 plus 28,000. Sorry, 28,800. I've got 32,300 in total. Okay, equals 32,300 rand. Right, and it's going to be limited to the lesser of. It is limited to the lesser of the cap. How much is the cap, Kokezo?
It's 350,000.
350,000 rand. And what else are we putting here? 105, right?
Yes.
105 from the 27.5. 105. Yes. And which one is the last one? Taxable income of 385,000, right? 385,000. 385,000 rent, but it's limited to how much? So we are taking the lesser in between this one. So it is limited to 105. Limited to 105. Okay, but 32,300 is the less amount. Is the less amount. Okay. So it's the one that is actually going to be deducted. So you're going to say 385, remember the taxable income up there, minus 32,300. Let's go back a bit. 32,000, okay, let's do this. 32,300, the one that is going to be deducted. And let's go up. Total income, 385,000. Let's put it here. Then you're going to minus 32,300. Somebody give me the final figure quickly. I'll give you that now, because I can see that we are running out of time. Right, 385,123 minus 32,300 is 352. So this will be the income before the donation. Before donation. So we're having 352, 700. Okay, and then we're going to look at donation, the PBO. So we're going to look at the donation amount itself is 2,500 rand, but it's limited to 10% of the taxable income, and then we're going to take the lesser in between the two. So the donation amount is 2,500. Okay, but limited to the 10% of the taxable income, okay, which is 352,700. Then we multiply this by 10%. Okay, so how much is 352,700 multiplied by 10%? 352,700 multiplied by 10, you divide this by 100. It's 35,250. 35,270, sorry, 270. So 2,500 is actually the lesser and must be deducted. All right, so you're going to have 2,500 rand here, and then you're going to deduct it. So you're going to say 352,700 minus 2,500. We've got 350,200. That's your taxable income. So the taxable income is 350,200. That's the final figure. Okay, I'm open up for questions. Come here quickly. Okay, Koketo, any questions from your side? Koketo?
There.
Yes, ma'am.
From the contribution to the limited of 105,000, I do understand.
Yes.
But from the income before donation. I don't understand anything. I'm lost. I don't know if you were fast because I was unable to calculate for myself to see where you got those answers from. Can you please start to explain?
Okay, no problem. So, okay, you get the income before donation of 35,700. You're fine with that.
Yeah, that one I'm fine with it.
Okay, there was a donation of 2,500 rand, and it was confirmed to be made through to the public benefit organization. So we received the Section 18A receipt, right, with an amount of 2,500 rand. However, before we can deduct that amount of money, we need to determine 10% of the taxable income. And we took the taxable income of 35,700 up there, and we multiply that by 10%, it gave us 35,270. Are you fine to that point?
Yeah.
Okay, the X says that we need to take the lesser in between the adjusted taxable income and the donation that has been made. So the lesser is 2,500 rand, which is the donation that has been made. That's why we have taken that one into account.
Oh, the lesser between 35,270.
Yes, and 2.5.
Oh, okay.
If our donation was 35,270, let's bring it here. 35,270, and then the adjusted amount was 2,500. Let's say the adjusted amount is 3,000 rand. We were going to say minus 3,000 here. That's going to become this. We are always taking the lesser between the adjusted taxable income and the donation made.
Okay, so how did you get the taxable income?
Okay. You mean, how did I get 35,2,700?
Yes.
Okay. 372,500 is actually from here. You remember when I was explaining the cap of 350?
Yes.
Okay. From here. Okay, we got incomes. They gave us a total of 385,000 rand. You must be following there. And then we were looking at the exempts. We don't have any exempt, right? We come to the contributions. Contributions, the aspects that we have to follow. Step number 1 says that we need to calculate the limit of 27.5% of the greater between the remuneration or the taxable income, which in here we found it to be the same amount. It's 385,000 rand. Let's say in the question they gave you the remuneration of 400,000 rand. We were going to use 400,000 rand because it's greater than the taxable income or the total income. So what we did is, because we only have the income, we said 385,000 multiplied by 27.5% of the 105,875. And then step 2 says that we have to look at the actual contribution. So our contribution contained of the retirement annuity fund and the pension fund, and it was 3,500 and 28,800 rand, and then it equaled 32,300 rand. And then we said it is limited to the lesser of 350,000 rands, 105,000 rands. That's there, step number 1, and then 385,000 rand. That's your taxable income. Right, so we found 105 to be the lesser. However, our contribution, it's way less than 105, which amounted to 32,300 rands. So we took it into account as the less. So what you do, because we found a less amount, you just say 385,000 minus 32,300 rand. Then we got to an amount of 35,2,700 rand as our income before donation. All right, from my side, thank you so much for joining me throughout the semester. Today, I am so done with you. And if you do have any questions, you can pose them through via the WhatsApp, or you can pose them through via the email.